Hi, welcome back to John Smith 02. If you've looked at silver prices in the last few days, you probably did a double take. The metal pushed close to $67 an ounce right after the latest inflation numbers came out. And if you've been watching this market for a while, you know that kind of move doesn't happen on a quiet news day. Something shifted. And today I want to walk you through exactly what happened, why it happened, and more importantly, what it might mean for where this market goes next. Because here's the thing about silver right now, it's not just moving. It's moving with intensity, and intensity like this always raises the same question in every investor's mind. Is this the beginning of something bigger, or is this the kind of spike that cools off just as fast as it showed up? Let's start with what actually triggered this move, because understanding the trigger is the key to understanding everything that follows. The latest Consumer Price Index report came in hotter than most economists expected. Now, when we talk about CPI, we're really talking about a snapshot of how fast prices are rising across the economy, everything from groceries to rent to gasoline. When that number comes in higher than forecast, it tells the market that inflation isn't cooling down the way policymakers hoped. And this is important because inflation data doesn't just affect what you pay at the grocery store. It directly shapes what happens inside financial markets, especially in metals like silver and gold. Here's why. When inflation runs hot, investors start questioning whether the value of their cash is quietly eroding. A dollar today buys less than it did a year ago, and if prices keep climbing, that same dollar will buy even less a year from now. Silver, along with gold, has historically been viewed as a way to preserve purchasing power during periods like this. So when a CPI report surprises to the upside, you often see a fairly immediate reaction in the metals market because traders and long-term holders alike start repositioning based on what higher inflation could mean for the value of paper currency going forward. But there's a second layer to this story, and it's just as important as the first. Hot inflation data also changes expectations around what the Federal Reserve might do with interest rates. Think about it this way. If inflation is accelerating, the Fed has less room to cut rates, and in some scenarios, hotter data even raises questions about whether rates need to stay elevated for longer than the market originally priced in. Now you might be thinking, wait, doesn't higher rates usually hurt silver? And that's a fair question, because historically higher interest rates can make non-yielding assets like silver less attractive compared to something like a savings account or a bond that actually pays you interest. So here's where it gets interesting, and this is the part a lot of people miss. The market's reaction wasn't just about the interest rate outlook in isolation. It was about the combination of hot inflation alongside growing uncertainty about the broader economic picture. When inflation surprises to the upside, while there are already concerns about economic growth slowing, or currency stability, or geopolitical tension in the background, silver tends to respond to that entire mixture, not just one single data point. In other words, the CPI report was the spark, but the fuel that made the move so sharp had already been building for a while. Let's talk about the physical side of this market too, because price charts only tell half the story. Over the past several months, we've talked on this channel about how industrial demand for silver has been climbing steadily. Silver isn't just a store of value the way gold often is. It's also a critical industrial metal used heavily in solar panel production, electronics, electric vehicles, and a growing list of technology applications. So you have two forces working at the same time. On one side, you've got investment demand rising because of inflation concerns and currency worries. On the other side, you've got industrial demand rising because of real-world manufacturing needs. When both of those pressures increase at once and supply doesn't expand quickly enough to match them, price moves tend to get amplified. That's part of why a single data release can send the price jumping several dollars in a short window, rather than drifting up gradually over weeks. Now, let's bring this back to the question everyone actually wants answered. Is the rally over? And I want to be honest with you here because anyone who tells you with total certainty what happens next in a market like this either doesn't understand how markets work or isn't being straight with you. What we can do instead is look at the different scenarios that tend to play out after a move like this and think through them together. The first scenario is what you might call a healthy pause. After a sharp move like the one we just saw, it's extremely common for a market to consolidate for a while. That means price might trade sideways or pull back modestly as short-term traders take profits and the market digests what just happened. This kind of pause doesn't necessarily mean the broader trend is broken. It often just means the market needs to catch its breath before deciding on its next direction. If you've followed silver for any length of time, you've probably seen this pattern before. A strong move up followed by a period of consolidation, followed by either a continuation or a deeper correction. The second scenario is a deeper pullback. If upcoming economic data comes in cooler than expected, or if the Federal Reserve signals a more aggressive stance than the market currently expects, some of the recent gains could unwind. This is a normal part of how markets function, and it's worth remembering that volatility works in both directions. A market that can move up several dollars in days can also give some of that back just as quickly. This is exactly why understanding volatility matters so much when you're trying to make sense of a market like silver. The third scenario is continuation, where the current move turns out to be the start of a larger trend rather than an isolated spike. This tends to happen when the underlying pressures we talked about earlier, inflation concerns, industrial demand, and tightening physical supply, continue to reinforce each other over time rather than fading. If inflation data continues to surprise to the upside in the months ahead, and if industrial demand keeps climbing at the same time, the argument for a sustained move higher becomes stronger. But again, this is a possibility to be aware of, not a guarantee to bank on. Before we go further, if you're finding this kind of breakdown useful, take a second to like the video and subscribe to the channel. It genuinely helps this content reach more people who are trying to understand these markets the same way you are, and I put a lot of care into making sure these explanations are grounded and useful, rather than just reacting to headlines. All right, let's keep going. Now, something I think is worth addressing directly is the emotional side of watching a market move this fast. When you see a price jump several dollars in a matter of days, it's natural to feel a mix of excitement and anxiety, especially if you already hold silver or if you've been on the sidelines wondering whether you missed an opportunity. Here's what I'd encourage you to keep in mind. Sharp moves like this are exactly why silver has a reputation for being more volatile than gold. Silver is a smaller market in dollar terms compared to gold, which means it takes less money flowing in or out to move the price significantly. That volatility can work in your favor, and it can also work against you, which is why it's worth being fully aware of it, rather than being surprised by it after the fact. Let's also talk about the historical context here for a moment, because it adds some useful perspective. Silver has gone through several major cycles over the decades, periods of sharp rallies followed by extended periods of consolidation or decline. What tends to separate a temporary spike from a genuine structural shift is whether the underlying drivers persist. A single hot CPI report is a data point. A sustained pattern of inflation surprises, combined with structural changes in industrial demand and physical market tightness, is a trend. Right now, we're seeing elements of both, which is exactly why this moment feels significant, but it's also why patience matters before drawing firm conclusions about what comes next. I also want to touch on something that doesn't get talked about enough, which is the difference between how this move looks on a trading screen versus how it's playing out in physical markets. Over the past year, we've discussed on this channel how premiums on physical silver products, things like coins and bars, have at times told a different story than the paper price you see quoted on exchanges. When physical premiums rise faster than the spot price, it often signals that real-world buyers are having a harder time sourcing metal, which can point to tightness in actual supply rather than just speculative trading activity. Keeping an eye on both sides of this market, the paper price and the physical premium, gives you a more complete picture than looking at either one alone. So how should you think about all of this without getting lost in the noise? Here's a simple framework that might help. Instead of trying to predict the exact next move in price, focus on tracking the underlying forces we've talked about today. Watch inflation trends over multiple reports, not just one. Pay attention to what the Federal Reserve communicates about its future path for interest rates. Keep an eye on industrial demand trends, especially in sectors like solar and electronics, and stay aware of physical market signals like premiums and available supply. When you track these forces over time, rather than reacting to any single headline, you get a much clearer sense of whether the broader trend is strengthening or weakening, regardless of what happens on any individual day. It's also worth acknowledging the other side of this conversation, because a responsible breakdown should always include perspectives that challenge the dominant narrative. Some analysts argue that hot CPI prints can be temporary noise caused by specific categories like energy or housing costs, and that once those categories normalize, inflation could cool faster than the market currently expects. If that happens, some of the urgency driving recent buying could fade, and money that flowed into silver on inflation fears could rotate back into other assets. This is a legitimate possibility, and it's part of why staying informed over time matters more than reacting to any single data release. Let's zoom out for a moment and think about why any of this actually matters to you personally, beyond just watching numbers move on a screen. Inflation isn't an abstract concept. It shows up in your grocery bill, your rent, your utility costs, and the overall cost of living. When you understand how markets like silver respond to inflation data, you're not just learning about a commodity. You're learning how to read broader signals about the health of the economy and the value of the currency you use every single day. That kind of understanding can inform how you think about savings, about diversification, and about long-term financial planning, even if you never buy a single ounce of silver yourself. Looking ahead, the next few economic data releases are going to matter a lot for this market. Additional inflation reports, further commentary from the Federal Reserve, and updates on industrial demand will all play a role in determining whether this recent move towards $67 turns into a lasting trend or settles back into a calmer range. Rather than trying to predict the outcome with certainty, the smarter approach is to stay informed, watch the data as it comes in, and understand the reasoning behind each move, rather than just reacting to price alone. So let's bring this together. Silver's move toward $67 wasn't random. It was the result of a hotter-than-expected inflation report colliding with an already tightening physical market and rising industrial demand. Whether this turns into a sustained rally or settles into a period of consolidation depends on how the underlying forces evolve over the coming weeks and months. What matters most isn't predicting the exact next move, but understanding why the market is behaving the way it is, so that whatever happens next, you're not caught off guard. You're informed. This video is for educational purposes only and should not be taken as financial advice. Always do your own research and consider speaking with a licensed financial advisor before making any investment decisions. If you found this breakdown helpful, let me know in the comments what you'd like covered next, and I'll see you in the next one.